Welcome to this week's Market Talk. I'm Amber Lancaster, joined by Paul Mampilly and Ian Dyer. Each week, we look forward to sharing our viewpoints with you, our readers, and giving you insight into what's on our radar. Today's outlook is for the week of March 11th, 2019. I'll begin by sharing with you what I'm watching, and then we'll hear from Ian and Paul. Last week's February jobs report, showing that only 20,000 jobs were added for the month, was a definite surprise. But after digging deeper, we here at Bold Profits Daily say, don't panic. We had a team discussion about the report Friday afternoon and came to this conclusion. For the months of December and February, as you can see in this chart denoted by the two green arrows, we saw extraordinary jobs growth numbers. December's non-farm payrolls saw an increase of 227,000 jobs added, while January's non-farm payrolls were revised even higher to 311,000 from the original print of 304,000. So if we were to average these extreme numbers together, all three, we're looking at an average growth rate of 186,000 jobs added over the last 3 months, which is more than respectable. The report also showed us that wage growth was the highest gain in average earnings for private workers, clocking in at 0.4%. And this gain in household income will more than likely show that stronger consumer buying will occur in the medium term. Plus, the jobs report showed overall that the unemployment rate ticked down to 3.8%. And this rate is 100 basis points better than what economists were expecting. All positives. And another piece of encouraging economic data from the last week was the housing starts numbers. As you can see in this chart, U.S. housing starts rebounded in January, surpassing forecasts. Construction on new homes rebounded more than anticipated. Housing starts rose nearly 19% to 1.23 million, while permits rose 1.4% to 1.35 million. Lower mortgage rates and rising wages are contributing to home builders' budding optimism. Therefore, as you can see in this graphic, for this week, we can expect the following economic releases. February's Consumer Price Index month-over-month print on Tuesday. The prior reading was flat at 0%, but economists are expecting a reading, a slight rise of 0.2%. Durable good orders on Wednesday. Surveyed economists are anticipating a print of negative 0.5% for this number. And month-over-month construction spending for January, the prior reading was negative 0.6, but economists are expecting a positive gain of 0.4%. Now, January new home sales numbers are on Thursday. Economists are thinking we'll see around 622,000 new homes purchased, which is about in line with the December's number. And then rounding out the week, we'll see Empire Manufacturing month-over-month industrial production for February and the ever-popular University of Michigan sentiment number, which will be the preliminary print for March. Now we're going to move on to the Federal Reserve front. It's being reported by Bloomberg News today, and I quote, that Federal Reserve Chairman Jerome Powell stated interest rates can remain on hold as the U.S. Central Bank waits to see how conditions abroad will evolve, signaling there's no clear time limit to the Fed's current pause. Now, Jerome Powell is quoted as saying on CBS News 60 Minutes that inflation is muted. And our policy rate, we think, is an appropriate place. And he called the current rate setting roughly neutral, meaning it's neither stoking nor showing growth and tied to the definition of the Fed stance, which is patience. So patience means we don't feel any hurry to change our interest rate policy. And that's what he said. So on the technology front, one of our ongoing themes here at Bold Profits Daily is watchfully keeping track of technological innovations. Clean Technica, a top online source for news on electric vehicles, wind, and solar, just reported that Australia is adding about 1 mega solar project per month. Australia's solar industry skyrocketed during 2018. 1.5 gigawatt of solar came online for the continent, about 10 times as much solar as came online the year prior. The utilities segment is the main cause for Australia's solar growth, but commercial, industrial, and residential installs also continue to record at record speed. So according to Clean Technica, as you can see in this image, Australia's solar irradiance is off the charts. Solar irradiance is the power per unit area received from the sun. Australia is a natural leader in this area. So worldwide demand for solar trackers continue to grow rapidly in locations with higher solar irradiance like Australia, where solar tracking cannot deliver 20 to 25% increase in power production. So residential solar installations also are growing rapidly for Australia, with nearly 2 million installations for the year so far, and that's equivalent to about 15,000 installs per month. And according to BP, they're saying that energy from solar will actually grow about 400% by 2040. And that's why we recommend great solar picks here in our premium services. And one recommendation, which was personally selected by Paul, is well positioned to ride the growing solar energy wave. So lastly, as this graph shows, our disruptification index continues to beat major indices more than 2 to 1 year to date. As of Friday's March 8th close, the index is up 21.9% versus 9.1% on the Dow and 9.4% on the S&P 500. So that's it from me. Ian, what are you watching this morning?
Thank you, Amber. So just building off of what you said in the home building market, there was a number released last Tuesday on new home sales for December. And that number revealed that in December, new home sales grew by 3.7%, which is good in itself, but it's very good because the expectation for December was that it would fall by 8.7%. So the fact that it was expected to fall that much and it actually grew is extremely encouraging for the housing market as well as the overall economy, because of course real estate is a huge part of the US GDP. And so this is really driven by the millennial trend of them getting into the housing market. And we've seen huge amounts of millennials in the past year. They grew their market share in the home buying market by 1.2%, and they now comprise about 36.8% of all home buyers. And they also are driving the first-time home buyers statistic. And there was recently also a report by Freddie Mac that 46% of the loans that they gave out in the first quarter of 2018 were first-time home buyers. So these trends are really shaping the housing market, and we believe that this is going to continue to grow. And a lot of people are saying that a shrinking housing market's coming and a recession is coming because of that. But of course, we're optimistic on both of those things. We don't believe a recession's right around the corner, as most people are saying. And we also believe that the housing market is going to continue to be strong. So the housing market's looking great. Another thing that I'm looking at right now is the subscription economy, which has really emerged over the past 3 to 5 years. And one of the big drivers of this was Amazon Prime, which, of course, as a lot of people know, is the service that Amazon offers. It's $99 a year. Actually, I believe that was increased to about $129 a year recently. But this is a service where they offer free shipping, free 2-day shipping for pretty much any product that you can buy on Amazon. They have all kinds of things, millions of products that you can get with free shipping. And this really sparked a trend in the online retail market as well. So Amazon also bought Whole Foods, of course, a couple of years ago, and this launched their Amazon Fresh service. So now they have a lot of different fresh organic food choices that you can order from Amazon. They deliver them once a week or bi-weekly, or really whatever you prefer. And this is another subscription that they offer. It's another piece of the subscription economy. We're seeing that a lot with food delivery. So Amazon Prime is one example of that. We're also seeing companies like Blue Apron that give you basically 3 meals a week that you can put together yourself. And it reduces a lot of worry because a lot of people go to the grocery store and end up buying the same things. or they don't know what they're going to buy, but they have a lot of variety with these services. So this is another weekly service with food delivery. So that's one aspect of the subscription economy. And another one is streaming. So when you say streaming, a lot of people automatically think of Netflix, which is, of course, the world's biggest online streaming movies and TV service. So monthly, Netflix can cost you anywhere from about $9 to $16. People really don't worry about this being taken out of their bank accounts every month, so it's extremely popular with consumers. People use it really every day, and it's also a very reliable stream of cash for Netflix. So any business really can benefit from that because they have a good idea of what they can expect to make from customers. People love it because it's relatively cheap. It's just a monthly small fee. And another player in that industry is Spotify, which has really taken off over the past few years. And this is part of the music streaming industry. They're the overall music industry. Music streaming is actually really growing its market share. So in 2015, music streaming represented about 34% of all the revenue in the music industry around the world. And in 2018, it had jumped to 75%. So music streaming is a huge growth business. It's only $10 a month, which again, people don't worry about $10 a month coming out of their bank account. So a lot of people listen to Spotify every day or services like that. So streaming is another huge area of the subscription economy. And Netflix and Spotify combined have over 250 million subscribers worldwide. So while that's a lot of people, there's still a lot of room to grow. And in a few years, we're going to see billions of people subscribing to these services, not just Netflix and Spotify, but their competitors as well. And so we're very bullish on this part of the economy. There are a lot of different opportunities to invest in. And we believe that this, as well as the home buying market, which I mentioned before, are really looking great, and they're going to continue to grow at a good pace. So that's what I'm looking at this week. And Paul?
Thanks, Ian. I actually saw something recently that said that Spotify, which just actually entered the Indian market, got 1 million subscribers in their first week, which is really mind-blowing and does show you the power of the subscription economy, the subscription business model, which is really the internet business model. People forget that someone had to create the retail business model, and we take that for granted. And Amazon really created and is creating what an online business does, how it operates, how it makes money. And subscriptions are a critical part of it, and which is why you see so many other companies beginning to imitate it, because there is now a proven pathway to success. So as you might know, at Bold Profits, we define innovation by this rather than some technology. It's really about us, which is that it's something that you do, let's say, every day or regularly. And innovation is that which makes it easier, cheaper, more convenient. And that's what really drives people to go from their old way of doing things to the new way of doing things. And that's really what innovation is. And when you provide that value to people, they'll follow you. And that's what, whether it be Netflix, Spotify, Amazon, well, all these companies that we define as the new are doing. And all these companies that define as the old, well, 50 years ago, they were the new. And people followed them into whatever changes they were making. And now they're the old, and now they're losing share. So I have some points that I want to bring up, which is that the one thing I noticed is that there is the beginning of rhetoric that is coming about because of the fact that we are now entering the presidential election cycle. And we have everyone from avowed socialists to people who are against capitalism, people who want to break up technology companies. There's a lot of stuff that's being discussed out there. And from day to day, you might see stock prices move up and down as a result of it. However, I believe you go out long term, it's unlikely that any of this rhetoric will ultimately really end up in anything that would actually affect these companies. Our country has been capitalist for a very long time. It is the basis of the way we live. It is really the basis of all of our companies. And so while the rhetoric is out there, I believe that selling or reacting to it would be a mistake. The other thing that I've been looking at is that theoretically, if you believe in the ideas of bull markets, we've just passed the 10-year anniversary of this bull market. And I just got some numbers together, which is that if you go back to the actual so-called beginning, which was March 9th of 2009, well, that would have been the moment at which $13 trillion in stock market wealth would have gone poof. And if you sold, you would have sold into that moment. Equally, because it was a genuine crisis that followed, we were losing 700,000 jobs per month at that moment. And using the worst way of measuring unemployment was really at 18%. So if you bought in now on March 9th, let's say you bought the S&P 500, you'd be up 305%. So it's been an extraordinarily lucrative thing to have bought in rather than sold. And you'll see a number of articles that talk about people's reactions to this new bull market, which is that I remember in 1999 and 2000, there was this absolute euphoria as markets went up, and there would be these pictures posted on the internet or in newspapers, and it would be people, just really being very happy. However, the reaction to this bull market generally is really grousing, sulking, people looking for reasons why it's going to end, why there's going to be another crisis, why there's going to be a problem. And a number of articles talk about the psychology of what happens after you go through a devastating moment like 2008, which is that people really dislike taking risks. They are really scarred. Like it's sort of like if you touch something very hot. And I tell my kids, well, if you touch something really hot, you'll remember forever never to touch the burning pot. And that's really what's now embedded into investor psychology. And we can see this the most really among young people. The statistics are that if you look at people under 35, just 38% of them own stocks today. And you compare that to before the financial crisis in 2007, that number was 14% higher at 52%. And so in our discussions, we were talking about, well, if the millennial generation ever came back into the stock market, they would really boost stock prices just significantly higher, because we've also done a lot of work showing that the number of stocks available in the market have shrunk by nearly a third. The number of shares outstanding are stagnant to what they were 10 years ago, even though the value has risen. So the per share value of stock has gone up. So the other thing that some of these articles bring out is that in 2007, there were just 19% of the amount of money was in index funds. Today, 43% of all the money that's in stock markets is in index funds. So in general, there's just much lower levels of risk taking, which if you've studied investor psychology, investor sentiment, economic history, market history, when you see people not wanting to take risks, that's generally a bullish sign. And I mentioned this a couple of weeks ago where I said that Bank of America had gone back and looked at portfolios and seen that we have the highest cash levels in portfolio accounts since really January of 2009, even though really our economy is growing. Unemployment is one of the lowest rates really in 30 or 40 years. And so that really shows that investor psychology seems to be really in sort of almost permanent low risk-taking mode, which is counterintuitively a very bullish sign, because it means there's a lot of demand, latent demand sitting in there for stocks that can push prices up. So I'm very bullish. I'm very optimistic, as I have been really since the beginning of this bull market. And I still believe there's huge gains ahead, which is why we keep telling people across all of our services to keep buying and to be invested. We also saw a piece of news this morning about Nvidia, which is now a very large chip company that really matters to a number of our megatrends, Internet of Things, robotics, blockchain, and others, buying another semiconductor company called Mellanox. And it's part of something that's been going on really for about 10 years, which is the semiconductor industry. It's consolidating. And we own a lot of semiconductor companies across the various services and bull profits. And it's one more reason really to own all of them. And in any number of Bull Profits dailies and Winning Investor dailies, I've recommended the Semiconductors ETF as a general way to play into all of our technology megatrends. Also want to mention that my publisher has a special promotion going for the $10 million portfolio where we're recommending an absolutely incredible stock, a phenomenal stock in virtual reality and augmented reality. And this is a company that very few people are thinking about, and it is dirt cheap. Ian and I did the analysis on this, and it pays a dividend yield, and they have been restructuring themselves to really laser focus on this virtual reality opportunity. And we believe that this is an incredible time to get into it. And even more, it's part of a market that is totally under the radar. It's an international market. Most people pay attention to China and India. However, this market, I believe, is way better in value, has unbelievable technology companies, and that's in Taiwan. So that's where this company is located. So if you're interested in that, look out for the emails that are telling you about the promotion that my publisher is running. So that's all I have. Back to you, Amber.
Thank you so much, Paul, and thank you, Ian. Great talk as always, and thank you, our watchers, for tuning in this week. We look forward to sharing our insights with you next week, and until then, have a wonderful day.